We've seen the government of the United States, every time needing money, they print money. You're not buying gold to make money. What you're doing, you're buying gold to protect your portfolio as an insurance.
This is what you're referring to as gold. You want people to have physical, tangible gold.
Absolutely, because ETFs and even crypto-backed gold, and we
There's a way to buy gold that's not physical and tangible.
Exactly. The problem with that is...
Welcome to another episode of Free at Last. I'm your host, James Catledge, and we are talking about subjects, businesses, concepts that allow you to become financially independent. That's what we want. We want you to become financially independent. Today's guest is my gold expert, and I've got Sami Chalfouh here with us today. Welcome, Sammy.
Yeah. It's my pleasure. Thank you for having me.
Yeah, thank you for being here. Now, Sammy is an expert. Now, when we say expert, there are people with all sorts of degrees and credentials, and they run around claiming expertise. This is the gentleman I go to when I have questions about gold. Now, gold, as it would be, that's why we've got Sammy in here. Sammy has flown in to be a part of this podcast today to talk about what's happening. So things are happening with gold that are very unusual. We're at 4,200 today when we entered the studio.
Correct.
Per ounce of gold. That's an all-time world record, taking it into account inflation and everything else. Is it up 60, 70% in the last 12 months? What's our up percentage?
About 70%. It doubled since January 2024.
It's doubled.
It more than doubled as of right now. It was at 2,089 on January 29th, 2024. Today is at $4,210.
Okay, what is happening? Why is it rising like this?
Good question. It's not one reason. It's a combination of reasons.
Okay.
There's the local inflation.
Okay.
That's number one. There's a currency war that we are witnessing globally.
Okay.
The Chinese, for the first time in many decades, are holding more gold than the Treasury bills. They have been dumping T-bills.
Interesting.
They used to be the largest holder and purchaser of T-bills.
They did, yes.
There's also a semiconductor war.
Okay.
The United States is fighting over Taiwan
Right.
for the semiconductors.
Yes.
Chinese as well. Then the most important news lately is that the BRICS countries have been trying over the past 10 years to create their own payment system.
Okay.
As they do so, there's no need for the SWIFT, which is Western control of money.
It's how we move money from account to account, the SWIFT system.
That is correct.
Yeah.
So now there's bilateral agreements within the BRICS countries, and for the audience, the BRICS countries are Brazil, Russia, India, China, South Africa, but they also invited a host of other countries that enjoyed that partnership.
Right.
Last June, June 2024, June 9th, the Saudi government decided to open the purchasing of oil products. It used to be the petrodollars, and most of you have heard of the petrodollars, right? Now, governments and companies can use their own currency or the Saudi currency to acquire oil products from Aramco and the Saudi market. So, to sum it, there's the inflation, there's the move away from the dollar, there's the currency war, there's the actual war, which in case of war, people are concerned.
Sure.
And, the debt ceiling and money printing that is happening in the United States.
Right, and we've been famous for money printing. As a central government, we've been printing money for years. And of course, gold is the hedge against all that inflationary effect of money printing. Take us back just a little bit. The audience who's now seeing gold in the headlines may not be familiar with the history of gold. Take us back to the gold standard. What does that mean when you hear the word the gold standard, that phrase? What does it mean? And then we were on the gold standard for a long time, and then we came off of it. So let's take us back through history here. What is the gold standard?
Thank you. Over centuries, the used currency was gold and also silver.
Okay.
Back in 1920, for example, if you had a $20 bill, that was equal to an ounce of gold. So after the Great Depression in 1928, is it? 1929?
Yeah.
After a few years, President Roosevelt enacted the recall of gold, the Executive Order of 1933, and he recalled gold from anybody that owned it, and mostly gold coins and bars, unless they're collectible, they were exempt. So in 1933, after the government enacted the recall of gold, they paid for it.
Okay, so when you recall gold, I just want to understand. You're President Roosevelt, and you're recalling my gold. I'm supposed to bring it into a bank?
Or you'll be fined $10,000 and years in prison.
Okay, so it's a criminal offense not to turn in my gold.
That is correct.
So I bring my gold to you in exchange for what? I'm assuming the government's buying it from me.
And the government did, but
Okay.
it was a rug pull because they paid you your $20
Per ounce.
per ounce, and that was the right
That
price.
was the London fixed price per ounce of gold.
Correct. So
Okay.
the dollar was pegged to
$20 bill.
$20 bill.
Okay.
Right, for per ounce. So after they did that, they pulled the rug and they revalued gold to $35. So if you had
Do we know how much gold they accumulated during this recall?
approximately, it is my understanding, what they say they have in the Federal Reserve, which is
Is that what Fort Knox is?
that's what they say. And I say that
What they say,
what
yeah,
they say
yeah.
because it hasn't been audited since 1956.
Okay, we've not seen the gold.
We haven't seen it.
Okay.
And when President Trump said we're
We're going to go to Fort Knox.
exactly, I've heard that J.P. Morgan flew in some gold
Interesting.
in the last year. But
Okay.
the story doesn't end in the rug pull and the devaluation of people's portfolio, because if you had $100,000 and it was in gold and you converted it to cash,
Yeah.
and then that was revalued, then your value of the dollar went down immediately by about 45%.
Yeah, because they took the value from $20 to $35.
That is correct.
Was that an arbitrary decision just because you don't control the whole gold market just because you recalled Americans' gold? So how is it he was able to revalue the ounce price to $35 per ounce?
It was literally a decision. The entire world, arbitrary decision. The entire world trusted the United States dollar and continued to do so because that was rug pull one. They said we're going to remain on the gold standard, so you can trust our currency. You can redeem your dollars against gold.
It is now at 35 an ounce as of 1933.
And it stayed that way all the way
Okay.
till 1971.
Okay, hold on. So it was pinned to a $35 value. An ounce of gold was pinned to $35.
Correct.
And London went along with this because London fixes where we get our per ounce price today.
Correct. The London fix had no
Meaning
because
Okay.
we are pegged to gold. In the dollar.
Yes.
35 is an ounce.
So it doesn't
we,
matter
we
what
don't
London
care what
says.
other people say.
We don't care because it's backed by the dollar and gold is the reserve of the dollar.
That is correct.
Okay, so now we get to the 70s. Tell me what changed.
So the 70s was the bigger rug pull. President Nixon took us off the gold standard, and our currency became a fiat currency. So what does the gold standard do for a currency? If you are pegged to the currency, you cannot willy-nilly print money.
That's right.
You have to, anytime you issue money, you have to have equivalent of gold
Yes,
to back
in reserve.
That is correct.
Yes.
However, if you are a fiat currency, then you can print.
You don't need the reserve backing to run the printer.
Correct. So it's a genius thing. It's bad, but it was a genius thing because governments around the world trust
Again,
the dollar.
the central government somehow is influencing the value of gold. So in 71, just so I understand it,
Yes, sir.
Was it President Nixon?
Nixon.
So President Nixon makes an arbitrary decision, probably with the help of his Secretary of Treasury, saying, look, we would like to print some dollars, and we would like to not have gold to back up those printed dollars. So someone made that decision that for the first time since 1933, we're going to now run the printer without the gold to support it. Is that what happened?
That is what happened. I mean, we can go down the rabbit hole. We're not going to do it now.
Yeah.
But it comes back to the early 1900s and Jekyll Island and the Federal Reserve
Sure.
and
And
all
them
that.
having meetings and becoming a central basically decision makers about how currency works and who has currency and who doesn't.
That is absolutely correct. Right. So what happened in 1971 after the second rug pull? We've seen the government of the United States, every time needing money, they print money. And there's nothing backing it aside from the credit rating or the trustworthiness of the United States.
The full faith and credit of the U.S. government.
That is correct.
Right. That's the phrase.
That is correct.
Right.
So
that phrase replaced gold.
That phrase replaced gold. And governments around the world found themselves, they can't dump it, because if they dump it, they're going to devalue the dollar and then they're going to lose. So they have to play the game.
They're playing the game.
They have to stick with it. And the best analysis is to look at the price of gold in 1971 and look at the price of gold today. Today is $4,200. Right. 1971 is $35. But guess what? If you were in 1970s, you buy a Cadillac for $5,000.
Right.
A really nice Cadillac.
Yeah.
Today,
it's $100,000.
It's $100,000.
Right,
so it's not that gold prices have gone up. And that's really the key. The key, you're not buying gold to make money. What you're doing, you're buying gold to protect your portfolio as an insurance, something tangible.
It's a hedge on inflation.
That is correct.
So the $5,000 Cadillac, to your great point, it's a great analogy, is $100,000 today for a loaded Cadillac. Could be a little more than that. But basically, the 5 going to 100 for the same product is, if you bought gold, it may move more rapidly than that, but basically you're trying to protect yourself from the devaluation of the dollar.
Absolutely. And
that's what you're doing.
We've seen that in different financial crises. Let's fast forward to 2008.
Yeah.
And I hear you talking about the market and what's happening, and your audience obviously has a lot of knowledge. So 2008, gold prices a little before 2008 was about $600.
Yeah.
The average loss in portfolios, 401ks, and regular portfolios was between 40 to 60%. So if you had $1 million in paper assets, stocks, bonds, all that good stuff, now you wake up the next day, it's worth 600,000 or maybe 400,000.
Yes.
However, if you took 200,000 from that and you put it into physical, tangible gold, and that's the word physical, tangible. I say it.
Yes.
We'll talk about it. But if you put it in gold prices went up from 600 to 1900, so it tripled. So you have your 200,000 down 600,000. The loss that you suffered is covered.
Made up by the gold,
and that's what we're seeing again. So at the beginning of this episode, you said gold is at the all-time high.
Yeah.
Historic, right?
Yeah.
Well, guess what? It has been an all-time high almost every day or every month over the past 2 years at least, was 2,000 all-time high.
All time.
And I speak to customers, and you and I talk, right?
Yeah.
The gold is high. Oh, I want to wait for it. You don't say that, but some customers will say, I want to wait for it to go down. And the question is, why?
Yeah.
Are you buying gold to make money or to protect your assets?
Yeah, right. Yeah.
Although,
what's the purpose of buying it? Yeah, you need to. This is such a good point. I want to make sure that the audience understands it because I'm learning it as you say it. When we think of equities and we think of our paper assets, we're thinking of a buying point. We're thinking of an entry point into the market. Like when price dislocation occurs, we put our money into the market. That's typically when you want to buy equities, when there's price dislocation. What you're saying is you should not think about gold this way. There's not a price dislocation. This is operating on different measurements. This is operating on a different barometer. We should be looking at how much of my portfolio do I want to hedge against inflation, period. There's not a dislocation that will ever occur.
Absolutely. And the reality is the prices will fluctuate. But if you have 100 coins in your hand, they're in your hand.
Yeah.
Right? No matter what happened. And to your point, I believe in diversification.
Sure, me too.
You should have your stocks, your bonds, we're not financial advisors, right?
Yeah.
But you should have your physical gold.
Yeah.
And also, although I do say that gold is an insurance policy of sort, a tangible protection of your portfolio, but if you put a chart with gold performance since 1970 to today, with the S&P 500, with the Dow Jones, with the performance,
and gold,
it's right there.
Yes.
I mean, and unfortunately, our dollar lost probably over 97% of its purchasing power
Right.
over the past few decades.
Yes. Yes. So let's talk about the phrase you've used a lot today, which I really appreciate you using it: physical, tangible gold. You cannot say that phrase about stocks. Physical, tangible stocks. You can't say that about your bank deposit, physical, tangible bank deposits. We're talking about, in the old days, people would hide their money in a mattress. They would hide their money perhaps in the freezer. They would open the safe and put their $100 bills banded by $10,000 per band in their safe. This is what you're referring to as gold. You want people to have physical, tangible gold, right?
Absolutely, because ETFs, I mean, there's GLDs and spiders
Sure.
and even crypto-backed gold, and we are
There's a way to buy gold that's not physical and tangible.
Exactly. The problem with that is it's still a great investment,
Yeah.
right?
It will
But
move with gold.
it will move with gold, but
Yeah.
God forbid the company or the counterparty
Yeah.
has a problem with their management problem or any financial
problem, yeah.
then you don't have gold.
Yeah.
You have you have the feeling that you own some gold, but do you really? Do you have it in your hand?
Right.
You don't.
No, you don't. So there's a lot of people, Real Financial, the financial planning firm, where all these great agents are out helping people save and invest and prepare for retirement. A lot of those guys run into clients who love physical gold. They love it. They've got it in their safe. If they go to a safe deposit box at the bank and you open that little door, there's gold in those doors, okay? Is that, a lot of people think of that as a relic to the past. They think of that behavior as somehow old-fashioned. Help dissuade me from that thinking. Why is it not old-fashioned? Why is it the way you should all be doing it?
I love that question, by the way, and I'll answer it with a true anecdote, a true story.
Yeah.
I've been trading gold, as you know, for 17 years. And one of those days, back in 2011, we had a young man. He was 21. He entered our offices. I was working with one of the largest trading companies at the time. And he had an envelope in his hand. It has $10,000 in cash.
Okay.
It was serially numbered, fresh,
Yeah.
and had the date of 1943. So he was asking, can I speak to a numismatist, which is an expert on currency and gold? Sure. So
What's that word again?
numismatist.
Never heard the word before. This is great.
Thank you.
Okay.
So numismatics is the expertise in the coins, the old coins.
Currency. A
Correct.
currency expert.
Yes,
Okay, good.
yes, sir. So a numismatist at the time, Steve, sat down with this young man and said, "So what's your story?" He said, "Well, my great grandpa in 1943 went to the bank and he pulled this cash and he put it in the envelope for me, not for me. He put it in an envelope and he put it in the will for his first great grandchild when he reaches 21." And that was me last week.
Wow.
My parents handed me this envelope, and this is from your great grandfather.
My God, from 43.
From 1943. So, going back to the question.
Yeah.
Had his great grandpa
Gold.
put it in gold in 1943,
Yeah.
right? He probably thought it was a relic,
Yeah.
right?
It's old-fashioned.
Old-fashioned.
Yeah, right.
Right? So, had he put it in gold, 1943, when he walked in was $1,900 an ounce. I did the math, was $589,000 worth.
My God.
If he had it in gold.
Instead of 10,000.
Instead of 10,000. So obviously we didn't want to break his heart.
Right.
Steve told him, "Well, congratulations, young man. You have a great grandpa that left you something beautiful. Spend it wisely.
Yeah.
Have a wonderful day."
The only thing that represented all that time was the marking on the bill of 1943.
Absolutely. No appreciation
None.
happened.
No compounding. That is a great story
Thank you.
to illustrate the power of compounding if you've got it in the right assets. So let's do this. In the past, and we've done some business together, I'm a fan of the American Gold Eagle. And
I love those coins.
You know that.
Yes.
And the reason I'm a fan of the American Gold Eagle is, number one, it's coined and minted in America.
Absolutely.
There's a $50 marking on each of the coins, even though each one of them today is worth $4,200 per coin.
Absolutely.
They come in 20 sleeve. They come in a sleeve of 20
Yes.
with a little red cap on it, and they're easy to store.
Yes.
So basically, 20 of those is $86,000. We're close.
Roughly, yeah,
$86,000 for each tube, which looks like a roll of nickels.
Absolutely.
It's basically this. It's heavier, but it's the size of a roll of nickels. And so,
roll of quarters.
yeah, because
Yeah,
it's just a
little
little
bigger.
The ounce is a little bigger.
Correct.
And they're beautiful.
They are.
These are beautiful coins.
Yes.
And when you pop off that red cap and you roll them out and count them out, you basically have $80,000 to $100,000
In your
per
hand.
sleeve in your hand.
Yes, sir.
Now, I'm not walking into a bread store or a grocery store or pharmacy to spend my coins. But if I needed to liquidate those coins, how would I do it?
This is answered in two ways, and both of them together. Number one, whether it's the American Eagle or the Royal Canadian Mint or any gold is
Krugerrand.
Krugerrand,
Yeah.
and the Perth Mint. There's
Some
hundreds.
common standard issues.
That is correct.
Yeah.
So it doesn't really matter. Really, I always say when clients, even when you and I spoke,
Yeah.
you buy the Eagle because you love it, and it's
Yeah.
a great coin. It's an American
Yeah.
coin.
Yeah.
So, but it doesn't really matter where gold is from. What matters is how are you going to use it.
Yes.
So the people that are buying gold in 1 ounce, they're not looking to sell it at 1 unit. So a lot of people like the flexibility of the smaller denomination. So the 10th ounce, the gram, the half ounce, the
Yeah.
quarter ounce, right?
Yeah.
So it depends on one's portfolio when they're looking, okay, I have $1 million I would like to buy. Some I'm going to put for safety and storage. Some of it I want to potentially use for barter and trade. And some of it I just want to pass down to my kids
Right.
and family, right?
Right.
So going back to the second part of the answer is how do I do it, right? You have 2 or 3 choices really. You can barter and trade.
Yeah.
Hey Sam, I like your car. Here's a couple of coins.
Yeah.
Done.
Yeah, $8,000.
You can buy
Yeah.
real estate,
Yes.
right? And I
Yeah.
know you talk about real estate
Yes.
as well,
Right.
Using physical gold.
Yes.
You can also go to a coin shop.
Right.
Don't get mad at me, but coin shops usually will not give you the full value because they need to make money, right? So they will usually give you 20 to 30 or even sometimes 40% below market so that they can make money. But the best way is to sell back, for example, to our company.
Yeah.
If you are our client, we provide you
You will
the
buy
liquid.
and sell the coins.
That is correct.
That's
we provide you the exit strategy because that's part of the issue is people, it's easy to buy. Oh, coins, gold, I'll buy it. It's easy. But they don't think about the exit.
That's right.
And that's what we do.
Okay.
In my firm, that's what we
Yeah.
do. We help our customers when they're looking to liquidate, they call us and we liquidate for them.
Got it. Got it. Now, typically, and this is just to help the audience understand this, when we're moving gold by the ounce back and forth, typically, and this is just standard procedure, there's typically a 5 to sometimes 7% commission or fee to actually trade that gold back and forth.
That is correct. So every single company that sells physical metals, they have what is called the spread.
Yes.
And the spread is the difference between what they buy it at.
Right.
But that's the ask.
The market value.
That is correct.
Yeah.
And then the bid is
Yeah.
what they sell it at.
That's
That
right.
is called the spread. And inside that spread, there's the commission to the sales guy, like my sales guys, for example.
Yes.
There's also the cost of the company.
That's right.
Of
moving that money around.
Of course,
Yeah, yeah.
and being in business.
That's right.
And every gold company has it.
That's right.
But the spreads do vary per company.
Well, what's interesting, those 2 words, bid and ask, that's exactly how you buy a stock.
Absolutely.
There's
yeah.
a bid price and an ask price.
Absolutely.
And that anybody who's bought and sold stock understands the bid and the ask. And it's that spread that those who underwrite those stocks, they're picking up that spread to actually accommodate you in your purchase of equity. Same is true of gold. You're just physically doing it. Now, I will tell you just anecdotally, in the past, when I've sold gold before, there are gold dealers who will look and they have monitors in their gold stores where they have the current price and they show a bid and an ask and they literally will accommodate the movement. And you just need to find one in your neighborhood or work right with Sammy and his team to do it yourself. But I love the idea that there is an exit strategy. Not that you would ever need it, but if you did, it's nice to know that your company, American Gold Bullion.
Great American Bullion.
Pardon me. Yeah, that's right. Great American Bullion. And that's a .com, right?
That is a .com, and there's a phone number there, 424-279-4608.
All right.
But they can just go to greatamericanbullion.com / page/real.
Okay.
And we do have a promotion because of Mr. Catledge here.
Okay, okay. So, so if anybody goes there, there's some benefits to doing so.
Absolutely.
Because you've created that. Okay, that's great. That's really good. We'll put that in the description and make sure everybody can find their way there. You know what I like most about you, Sammy, and I want to say this before you leave today. You are an expert in this area. This is just not your business. You're an expert. And it's rare to be an expert. You've spent 17 years, well over the 10,000 hour mark, which we know it requires to be an expert. And I like myself, people who are in the money business, people who are in the getting wealthy business, getting ahead business, who are experts. You need a network of people like Sammy in your life. You need to have people who are experts in these arenas that you can call upon. So as you're making your moves to become financially independent, you've got a resource like this. And so I would just advise you and encourage you to call Sammy, call his firm. Now, he's got a big firm. Lots of people working for Sammy. But I believe if you reference the show, Sammy would probably want to talk to you and have a private conversation and let him guide you in your own moves. Sammy, it's been great having you here today. I hope you'll come back because gold is moving. Things are happening with gold that's probably going to require you to educate us more as we go forward. Thank you for being here.
Thank you for having me.
Yeah, thank you, brother.